love the channel and find it useful in becoming a happy retiree. Subscribe today. Stocks at all-time highs, but something doesn't feel right, does it? And we're going to talk about the reasons and the solutions for this angst that I know that you're feeling. And I know that you're feeling this way because I continue to see it and hear it from families that we talk about, that I talk to every day, every week. And it's the pulse of America that is, it still has this feeling of angst. It's not a euphoria. It's not like 1999 when everyone's jumping into internet stocks thinking they're going to retire super early because stocks go up 25% a year. That's not the feeling today. Yes, big jobs number this week. Jobs number 209,000 jobs for July. The unemployment rate down 4.3%. It's a 16-year low for the job market as far as the unemployment rate. We want that number to be at a low, but it still doesn't feel right. So the market, though, itself, all-time highs. Does it feel like the market is at an all-time high? I would ask you to answer that, and I bet you say, well, I don't know. It doesn't feel that way. So does it feel like the market is at an all-time high, or does it feel like skepticism is at an all-time high? So as the Dow sits at over now 22,000 on a little bit more than 22,000. So from the conversations that I have had lately with investors, skepticism is the one that's winning the race. Skepticism is the one that it feels like is at an all-time high. So Washington isn't coming to the table with anything new. The Fed isn't coming to the table with anything new. The latest job report we just talked about shows that even though we keep adding jobs to this economy, again, another 209,000 for the past month, wages still aren't rising. So we're stuck at that same 2.5% wage growth rate that we're confounded by. We seem to can't get out of. And that same 2.5% growth rate in wages alone, that goes all the way back to 2013. If you look at a chart at wage growth, we have been stuck at this same low speed for a very long time. So as humans, and note the word humans, not investors. So as people, we expect something. We're always expecting something to happen. We expect things to either get better or things to get worse. And when we're subject to this slow growth malaise, day after day, week after week, month after month, year after year, I call this the 39 miles per hour economy. Humans get a little antsy, and that's where we are right now. That's where we are today. We see markets making all-time highs, but we're not seeing it. We're not buying it. Yeah, honey, the Dow's up, but from where I sit, and this doesn't matter what profession that you're in. You could be a lawyer or a doctor. You could be selling something. You could be selling software, selling soft goods. You could be selling shoes. Doesn't matter. It doesn't seem like business at work is the best it's ever been. Again, stock market best it's ever been. Is your business the best it's ever been? I doubt you say, honey, this is the best things have ever been. So it's this disconnect between how we see the real world economy versus what we see on the nightly news. If you still watch the nightly news, hopefully you listen to the nightly news here on WSB Radio or the evening news, and you need a little bit of traffic weather with your news. So versus the disconnect here, real world economy versus the stock market, and that's where we invest in the real world to harness the collective power of the economy. That's why we invest to begin with. That's the whole reason we're doing this. But all of this disconnect, that's what makes us a little bit skeptical, or maybe a lot skeptical, suspect, uncomfortable. And I think that's the state that so many Americans are in today. Just uncomfortable with the disconnect of a great market, honey, and just an okay real world economy. Now, enter in all the market-related catastrophes that we've both lived through. And we've lived through a bunch of this in the past 17 years. 2000, 2001, 2002, 2007, 2008, 2009. That's a lot of that period of time was spent in, doldrums would be a light way to put it. 2008 doesn't seem like that long ago when there was a fear that every bank in America was underwater. Wasn't that long ago. It feels like yesterday for most of us. And that uncomfortability and that sense of disconnect, that just makes us plain nervous. It makes you nervous as an investor. Makes Luke Moss nervous as he's holding his iPhone, trying to film today. Good morning. So that's the conversation that I've had over this past week, really over this past month, over this past year. And the question I get is, hey, Wes, I'm nervous. What am I supposed to be doing? Now you enter in, and there's a lot to be nervous about because you enter in the months that we're headed, now that we're in August, and we're headed into September, and we're headed into October. Those historically tough months for the market, and we haven't had any correction for a very long time. The first half of 2017 was the lowest volatility month that we can remember. You've got to go back a couple decades before you can find something like that. And then the disconnect between how the economy is, where the market is, and this 39 mile per hour economy. If you haven't heard the analogy, we have had this steady growth rate of over 3% a year. Let's call it 3.1% to be exact for almost 50 straight years. Very much a straight line. Then you get to the Great Recession in 07, 08. And yes, we've recovered from that, but we've never recovered at the same pace of what we got used to for 50 years. So we were used to 3.1. We've decelerated now to 1.9. That might not sound like a lot on paper. Hey, let's round that off, Wes. Isn't that just 3 to 2? Is it really a big a deal? Well, really, it's 3.1 to 1.9. It's a 35% reduction. If you're used to driving 60 miles per hour and you've done that for the better part of a one-day trip, and all day long you've driven 60 miles an hour and you're almost home, you're 100 miles from home, and now a governor comes on your car and says, boom, 39, that's all you can go for the remainder of the trip. You're going to get antsy. You're going to get frustrated about how slow that feels relative to what you're used to. And that's where we are today. Now you enter in, what are some of the other factors that contribute to our angst in America? How about the rising cost of healthcare? I think that's one of them. And it's not just the cost of healthcare. If you really think about it, it's the wallet share that healthcare is now taking from you versus what it did 10 and 20 and 30 years ago. That wallet share, partially is because the number of procedures and tests and all the new things that have been introduced, those have skyrocketed. It's not just the cost. How about the dual income trap? Since 1975, and this is something that doesn't ever get reported on, the Equal Credit Opportunity Act was passed in 1975. That essentially encouraged dual income households. Can you believe before that act in 1975, you're trying to go get a mortgage, husband and wife, and banks didn't have to count the wife's income? In 1975, the Equal Credit Opportunity Act essentially said, no, you got to look at both incomes here in America. And that provision was a gigantic change in family economics. And then if you look at how that's played out over the years, we have more and more dual income households than we've ever had. And what does that do? On the surface, it sounds great, but it's also created a greater risk that somebody in the household loses a job. So it's not just one person anymore, it's two people. And if it takes two to make the mortgage payment, now all of a sudden there's a higher probability that one of those two jobs goes away. We've increased housing prices. We now have people have bought in neighborhoods and the average home prices continue to accelerate. And now all of a sudden the risk though in the economy that somebody loses that job, the family economic risk is higher than it used to be. Student loans of $1.3 trillion. Let's call that an anvil around the neck of so many when you're getting started in the real world. You can take a risk going out and starting a new business. And you already have a $1,000 a month student loan payment. You're a graduate degree. You're going to go out and start a new business. You have a $2,000 a month mortgage / student loan debt to repay. No, you're going to probably take the conservative route. So the economy itself has experienced all of these variables that have slowed us down. And it's creating this angst. And I want to talk about some of the solutions. If you're a nervous investor, and I know you are, that's the collective voice of what I've heard over the last several months that we're going to talk about some of the ways you can think about this economy moving forward and what you should be doing as an investor. I heard from a client of mine this week, hey, Wes, it seems like these corporations are doing okay, but where is all that money going? Doesn't feel like the rest of us are participating in any of that. Again, another reason for this feeling of uneasiness and this feeling of angst. And we're going to talk through how you can think through the very emotional and mathematic, but the harder side of this is the emotional side, business of investing over time and trying to get to a place where you can stop working and stop worrying about all of this. The very worries that we think about on a daily basis, and it comes to the economy and the stock market, and right now, this seemingly disconnect between the two. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.